If checking your investment account feels like opening a haunted house door, you are not alone there. A lot of people think investing anxiety only happens to beginners, but even experienced investors, they feel stressed when the market drops. Headlines scream disaster, and everyone online suddenly becomes a financial expert for 24 hours. And one bad day in the market can make people question years of planning, and one red number can feel personal. And the weird part is, investing is supposed to create freedom, but for a lot of people, it creates constant tension instead of. So, today I want to talk about the real relationship between money and anxiety, and why your brain reacts the way it does, and how to invest without turning every market dip into a full emotional breakdown. Because if your emotions control your investments will eventually control your life. And the first thing you need to understand is that your brain was not designed for modern investing. Human beings evolved to survive immediate danger, not watch charts move up and down all day on a, glowing rectangle in their pocket. Thousands of years ago, stress meant something physical was chasing you. Now, stress means your index funds, they dropped 4% before breakfast. Your brain does not fully understand the difference. And this is why investing can feel so emotionally intense. Your body reacts to uncertainty like it is a threat to survival. So when you constantly check your stock prices, doom scroll your financial news, and panic over short-term drops, your nervous system stays in fight or flight mode, and this is exhausting. And ironically, anxious investors, they usually make worse decisions because fear pushes people towards short-term thinking. You know, one of the biggest mistakes anxious investors make is believing they need perfect timing. People wait forever, trying to find the exact bottom of the market. They want a magical moment where the universe sends them a certified letter saying, "Yes, now is the perfect time to invest." And that moment, it never comes. Even professional investors, they fail at timing consistently, and markets move based on millions of decisions and world events, earning reports, and interest rates, politics, emotions, and sometimes just pure chaos. Trying to predict every moment is like trying to predict where a squirrel will run after drinking an energy drink. Long term investing is not about perfection, it is about the consistency. Another huge source of anxiety comes from unrealistic expectations. Social media has completely distorted how people view investing. And you open your phone and see somebody claiming they turned $4 in a chicken nugget into a Lamborghini using options trading. Nobody posts the thousands they lost before the screenshots. And nobody uploads videos titled, "I made reasonable long term financial decisions and slowly built wealth over 20 years." But that boring strategy is exactly what actually usually works. And real investing is often repetitive, disciplined, and emotionally unexciting. And the problem is anxious investors, they constantly compare their steady progress to someone else's highlight reel. And one of the best ways to reduce investing anxiety is automation. Seriously, automation is underrated psychological armor. And when you automatically invest your money every month, you remove a huge amount of emotional decision making. You are no longer asking yourself to today feel safe enough to invest. The system just automatically handles it for you. And that matters because emotions, they change daily. A strategy built entirely around emotion, eventually it just falls apart. And automatic investing creates consistency during both optimism and fear. It helps you build during good times and bad times without overthinking every headline. And let's talk about the market crashes for a second because this is where anxiety really explodes. And every crash feels unique while it is happening. And people say things like, "This time is different, and the economy is doomed, everything is collapsing, and civilization is ending." And somehow, there's always a guy online predicting canned beans will become the new currency. But historically, markets have recovered from recession, wars, inflation spikes, and political chaos, housing crashes, banking crises, pandemics, and countless disasters. And that does not mean crashes are fun. They are emotionally brutal, but zooming out historically changes perspective if your investment timeline is 20 or 30 years. And short term panic becomes less powerful. Now, does this not mean you should blindly ignore risk investing without understanding your own emotional tolerance is dangerous? Some people build super aggressive portfolios because they want massive returns, but then they panic during volatility and sell everything at the worst possible moment. A strategy only works if you can emotionally survive it. Seeing giant swings destroys your sleep. You may need a more balanced approach. This is no trophy for having the most stressful portfolio. No. Investing should support your life, not emotionally hijack it. Another thing anxious investors struggle with is overconsumption of financial content, except my content, okay? You can always overconsume this. Just saying. This is one that surprises people. They think consuming endless financial news will make them safer. Sometimes it does, and the opposite. And most financial media is designed to keep your attention, and fear is excellent for attention. Headlines are dramatic, and because calm headlines do not generate clicks, and nobody clicks videos titled "Markets Continue Existing Normally." Instead, you get headlines screaming about crashes, bubbles, collapses, emergency alerts, and economic nightmares every other day. And the constant exposure of fear based content, keeping your anxiety elevated. Staying informed is good, and obsessively monitoring every financial option on earth is not. And here is something else people rarely discuss too. Investing anxiety is often connected to deeper fears about security, identity, and control. Money represents survival for a lot of people. It represents the freedom, the stability option, and future safety. So when investment fluctuates, it can feel like your future is fluctuating too. And that emotional connection is real, but you cannot build long term wealth while demanding constant certainty because markets are inherently uncertain. The goal is not eliminating uncertainty completely. The goal is becoming emotionally resilient enough to handle it. And a practical way to reduce stress is building an emergency fund before aggressively investing. This changes everything psychologically. Knowing you have cash reserves creates emotional breathing room. And without that emergency savings, every market drop feels catastrophic because you might actually need the money soon. But what you have several months of expenses saved separately, investments can stay invested longer. And that separation between short term survival and money and long term investment money reduces the panic dramatically. And diversification also matters more than for mental health than people realize. When all your money is tied to one stock, one crypto project, or one trend, your emotional state becomes attached to a single outcome. And this is mentally exhausting. Diversification spreads risk across different assets and sectors, which helps reduce catastrophic losses. It may not sound exciting, but excitement is overrated in investing. Boring strategies have quietly built more wealth than emotionally charged gambling disguised as investing. You also need to stop viewing temporary losses as personal failure, okay? This is huge. Markets go down sometimes. This is normal. Declining portfolios does not mean you are stupid. It does not mean you will ruin your future. It means markets fluctuate. Anxiety grows when people personalize every movement. They feel shame, embarrassment, and regret over normal volatility. Long-term investors understand that downturns are part of the process, not proof the process is broken. And one mental shift that helps enormously is focusing on the ownership instead of the price. If you own broad market index funds, you own pieces of real businesses employing real people, creating real products and services day to day, and prices move constantly. But businesses continue operating underneath the noise. Thinking like an owner instead of a gambler changes your relationship with the investing. Gamblers obsess over short term swings, owners focus on long term growth. There's also a dangerous cycle where anxiety causes inaction and people, become so afraid of losing money that they never invest at all. But avoiding interest investing entirely has risks too. And, inflation slowly erodes purchasing power over time. Cash sitting still loses strength gradually. So the goal is not avoiding all risk forever. The goal is, learning how to manage, reasonable risk intelligently. Doing nothing may feel emotionally safer today while quietly creating financial problems tomorrow. And one thing that helped many investors historically is understanding probability instead of certainty. People desperately want guarantees, and investing does not offer guarantees. It offers that probability over long periods. Diversified investing has historically produced growth despite volatility along the way. This does not mean every year we will be positive, and some years are ugly. But long term thinking changes the equation. Anxiety often comes from demanding certainty in a system built around probability. Another underrated solution is reducing the frequency of checking your account. Seriously, if you check your portfolio 15 times a day, you are basically volunteering for emotional whiplash. Short term fluctuations look terrifying under a microscope, and long term charts look much calmer. And constant monitoring tricks your brain into believing every movement requires immediate action. And most of the time, it does not. And finally, understand this: wealth building is not just mathematical, it is psychological. And the people who succeed long term are not always the smartest. And often they're the most emotionally consistent. They create plans that can actually stick with during fear, excitement, greed, and uncertainty. They accept the volatility as part of the journey instead of treating every downturn like the apocalypse. Investing anxiety never disappears completely because uncertainty never disappears completely. But when you stop expecting certainty, stop chasing perfection, stop comparing yourself to internet millionaires, and start focusing on long term consistency, investing becomes less like emotional warfare and more like a practical tool for building freedom over time. Your goal is not to predict every market move, your goal is to create a strategy calm enough to survive bad days and strong enough to benefit from good years. Because the biggest threat to most investors is not usually the market itself. It is panic, it's impatient, and emotional decision making. Learn to manage those, and you're already ahead of most people. If you found value in today's video, just subscribe. That's all I ask. We're looking to build this channel, and without the subscription base, we can't grow. So please subscribe if you found value to this. That's all I ask. Thanks for watching. We'll talk to you guys on Monday. I'm taking the weekend off. See you guys later.